some changes are to be done at the buyer's end. Then it is shown back to the supplier in GSTR1A, 2 more days are allowed, and then GSTR1 and GSTR2 are matched. When the tax is paid on filing of GSTR3, then the credit becomes confirmed. So the system has been devised in such a way that everything gets auto-populated, we work in digital environment. We have to also keep in mind that when the taxes are being paid, let us say in Delhi, and the buyer is located say in Kerala, the tax is paid here, the credit is available to a dealer in Kerala. Not only the IGST credits, but the CGST, SGST credits are also allowed to be cross-utilized. We are having central levies, we are having state levies. World over, this system is not there of allowing cross credits. It is only on reverse charge basis that the tax is paid in the recipient state and then the credit is paid. So what results in originating state is, in this example in Delhi, that the dealer in Delhi will have to claim refunds. So we are not staring at hundreds of refunds to be received from the government, because the self-adjustment of taxes is being allowed. So, keeping all this in view, that the taxes are being paid in originating state, although the tax accrues to the destination state, the cross-utilization of credits are being permitted. We could have said that cross-utilization of credit will not be permitted. On IGST you pay in cash and then you take refund of the CGST, SGST credit. So when you see overall, then you will appreciate that why this system has been put in place. On the top of it, there is a provision which has been made, which is called GST compliance rating. It will not be immediately available, but it will be available over a period of time as and when the compliance behavior of the taxpayer is known. It will be put in public domain so as to allow the dealers to choose their trading partners. But if I choose to deal with a taxpayer who is not habitually compliant, then I should run the risk, why the government should run the risk. And if you are dealing with the taxpayer who is compliant, then there is no reason that he would not pay the tax and you will lose the credits. At the same time, provision has also been made that when the supplier pays the tax, which has been denied as credit because of the mismatch or because of non-payment by the supplier, the recipient gets the credit. So please see the overall philosophy of the GST regime and then appreciate that why this provision has been made. So at the same time, I would also say that are we linking the credits on payment of tax? Are we not allowing the credits even though the buyer might not have paid to the supplier? Should we link it to the Ecoterms between the buyer and the seller, that the buyer would get the credit only when the supplier has paid when buyer has paid to the supplier? Or if he has not paid to the supplier, then credit will not be allowed, although the supplier might have paid to the government. So we have to see the overall architect of the GST regime and keeping in view that everything would be digitalized, the credit would be allowed throughout the country, taxes being paid in one state, allowed in other state, cross-utilization of central and state levies, going for not for the reverse charge mechanism in case of interstate sale, which is the practice world over, because it would have led to huge amount of refunds, as I said earlier. So please see all this, and then it is our belief that we would be able to run the system properly, and over a period, initially there may be some issues, but over a period of time, as we gain experience, everything would fall in place. I would request you to introduce yourself and then.
I am Aditya Mathur, Chief Operating Officer of SIGPA India. There is a requirement of registration of non-residents under GST. Will this also apply to the holding companies which are exporting goods to their subsidiaries or JVs in India? Will they be required to get registered in the GST?
Holding companies are located where?
Outside India.
Why they will obtain registration? Please see the provision of casual taxpayer and non-resident taxable person. These are the existing provisions in VAT laws, and these are primarily for those purposes who come to India and make supply in India. For example, somebody participates in the trade fair, which is an annual trade fair in Delhi. So somebody comes from Malaysia or any other country, he don't have any registration in India, but he is coming to India to make taxable supplies in India, right? So therefore, because he is making taxable supplies, one way was to ask him to obtain a regular registration, file his regular return, pay taxes regularly, and then surrender the registration, and then wait for that surrender of registration before going back. What has been provided here now is that he would be given a temporary kind of registration for a period of 90 days. If he wants to extend, he can extend for further period. He will estimate his tax liability, he will deposit, and once he goes back, then he will file his final return, and that is the end of the matter.
Right.
So only if the holding company, in your case, comes to India and makes a taxable supply in any state in India, then only holding companies would be required to obtain registration.
Thanks.
Just a follow-on question. Is he eligible for input credit?
Sorry?
Is he eligible for input credit?
He is eligible for input credit on imported goods.
No, so he is availing the stall.
He is?
Exhibition premise.
The law doesn't provide for the credits for those goods or services which he procures in India. He will get credits only because what is being done today is that he brings his goods from outside India to sell in the stall in India. So what has been provided in the law is that he would get the input tax credit only on the IGST paid at the time of import, not other credits.
Because other part of the provisions are silent about it. They are not talking about whether to give or not to give credit to him. So one of the interpretations...
No, I think there is some provision which specifically says that he would get the credit. I will not be able to...
It is specifically provided in, I think, if I am not wrong, it is provided in Rule 16 itself, or Section 16 itself, that the person who is basically NRI is eligible for IGST credit on import of goods only.
Only.
Specifically mentioned in this.
Okay.
Good evening. I am Deepak, working from Carstores Endoscope India Private Limited. I have a question. If we have made a supply in terms of the FOC or in terms of the warranty, so that is one question where such supplies are taxable under GST, and whether we can take the credit of the duties paid under those for the import of those goods. And the second, if we are moving the goods for the demonstration equipments on a returnable basis, so are we, and they are classified as a fixed asset in our balance sheet, so are we eligible to take the credit of, again, the import and liable to pay the GST when we move the goods?
What is first question?
One, if you are supplying the good as an FOC, free of cost sample means under schemes 1+1 or something like this, because we normally sales the equipments. With equipments we give some consumables free or some equipment free. So in that case, are we liable to pay GST, or we are giving the goods, supplying the goods as a warranty?
No, if you are supplying goods under warranty, then because at the time when the warranty was entered into, you would have paid the full tax on the warranty, because that is the supply of service. So whatever goods you are using for complying with your agreement with the customer for providing the warranty, then again you will not be required to pay GST on the goods used for fulfilling the warranty agreement. But as far as demonstration is concerned, because the credits would be allowed when you procure those goods, inputs or capital goods, they become capital goods if you have capitalized in the books of accounts. So when you are moving it for demonstration purposes, then in invoice rules we have provided that you will have to move it on a challan because it is movement without supply for reason other than supply, and then but it has to be some time limits have been mentioned there. So that being the case, when if it doesn't come within the specified time as mentioned in the, I think invoice rule may have that provision, so then at that point of time you have to make the payment. But you know, that is how it has been handled in the in the invoice rules also.
Okay, thank you. And regarding free of cost also, that free of cost goods supply made as a free of cost, like in terms with one equipment I.
So if you fall in Schedule 1, if you satisfy the condition which are prescribed in Schedule 1, then you will have to pay the tax. So not all free supplies are taxable. The specified free supplies have been made taxable.
Okay.
And supplies without consideration are mentioned specifically in Schedule 1.
Sure, thank you.
Follow-on question, the goods supplied under a warranty, which would be without any consideration.
Sorry?
Goods supplied under warranty. So for example, if I sold a car and 2 years warranty, some of the parts fail and I supply free to the customer. So that is not considered to be an FOC supply, and therefore there is no need for me to reverse the underlying credit against that supply. Is that right?
Yeah.
Okay.
My name is Vikas. I come from a company called Fortune Stones, and we are 100% EOU. But we don't know that how the various exemptions which are available to us currently going to be handled in the GST, particularly like the excise benefit that we have on the CT3. So the benefit of excise duty that we have on the CT3. So now it means that we have to start paying the various taxes and then claim refund for it, or the provisions are still to be made clear for 100% EOU.
Are you talking about duty-free procurement?
Yeah, duty-free procurement particularly.
See, as far as duty-free procurement is concerned, it will be decided while deciding the rates whether the procurements would be subject to without payment. As of now, the thinking is that it has to be on payment of tax and you have to claim refunds at the time of exports. That is the current thinking. We have made an exception for SEZs in section 16 of IGST Act, wherein it has been said that the supplies to SEZ will also be treated as zero rated supplies, so they are given the same treatment as exports. So therefore, either whether you do physical exports or you supply to SEZ, you get refunds. For other, now SEZ are importing also. Will they get BCD exemption or not? That is customs portion. But in addition to BCD, today CVD is charged, now that will be replaced by IGST. Will they get IGST exemption? That decision is yet to be taken, and that will be taken by the GST Council while deciding the tax rates. So similar thing will be available, will be decided in case of EOU also, but you will find that there is a specific provision for payment of tax by EOU when they sell the goods to DTA today. There is no such similar dispensation in GST law. So therefore, to that extent, that will not continue in GST. So will you be allowed to avail duty-free procurement? We are waiting for the final decision to be taken by the council.
Sir, I am Subodh from PTI. We are exempted from service tax under mega exemption. Will it continue in the GST regime or?
We didn't get your question.
I am from PTI. We are exempted from service tax under the mega exemption regime. So will it continue in the GST regime also? Will it continue to get?
See, you must have heard the GST Council's decision when the 4 tax rates were announced. The 4 tax rates were 5%, 12%, 18%, 28%. Then certain luxury and demerit goods would be subject to cess. The decision which was taken by the council was that now the individual items would be fitted into these slabs. And when we start fitting these items in these 4 slabs, what has been said was that you please see the present incidence of tax on these items. It is not tax rate, it is incidence. So today some item may be exempt from central excise if you don't avail input tax credit. Otherwise, if you are taking an input tax credit, then you are in 8% bracket. If you are not availing input tax credit, then you are in 2% bracket. So what is the incidence of tax? Is it 2% or 8%? So to my mind, it is 8% and not 2%. And you also see what is the VAT rate on that item. Club the incidence, then see where the goods or services would be fitted in. It is basically for goods actually. So therefore, accordingly you fix the slab. So the thinking is that we'll fix the items in these 4 slabs, keeping in view the present incidence of tax, and broadly speaking, the present exemptions, if something is exempt today, that should continue to remain exempt in GST. So those decisions are to be taken by the council when we take those fitment work to the council to arrive at the final tax rates or final exemptions on various items. But generally speaking, if something is exempt today, it should remain exempt, generally speaking.
Good evening, sir. Myself Vishnu Upadhyay. I am a cost accountant and giving the consultancy to the company who is working as a warehouse management services in different locations of the countries. We are located at Delhi as a registered office and our corporate office in Gurgaon. We have around more than 15 states, our warehouses. And we are providing 2 types of warehouse services. We are taking on lease and further giving on lease to our customer. And another is we are providing the management services to the customer on their own warehouses. So do we have to register in all the states where we are taking on lease the warehouses?
आप ही बताइए आंसर, मेरे से क्यों पूछ रहे हैं इसका आंसर?
Sir, I am not clear. I am clear, but I am not able to convince everyone. So I am asking as a final authority from you.
No, the law is very clear that you have to obtain registration in
Yes.
all those states from where you are making taxable supplies.
Yes.
You are providing warehouse services from 15 states.
Yes.
So therefore you have to pay taxes from all 15 states and therefore you have to obtain registration in all those 15 states. Suppose if we don't do this, then what happens? Suppose that warehouse is rented one.
Yeah.
You pay GST on that.
Yes.
Will you be able to avail credit on that if you are not registered in that state? Because the place of supply for immole property is the location of the immole property.
Yes.
So if you are located in, if you have hired a warehouse in Tamil Nadu,
Right.
you are paying GST, the location being Tamil Nadu, you pay CGST and SGST in Tamil Nadu and you are not registered, what will happen?
Yeah, fully agree. I was also
So
having the same opinion, sir.
So therefore the point is that the law is very clear that there is no concept of centralized registration in GST.
And
And therefore you have to have registration in all those states from where you are making taxable supplies.
okay, sir. Thank you. And one more thing, in the same applicability will be there where we are providing only management services, not we are having the rental warehouses. Same will be applicable for those also? No.
See, you are providing services there is not the criteria for obtaining registration. The criteria is from where you are making supplies from. If you are based in Gurgaon, from Gurgaon itself you are giving consultancy service to your clients located in 3 states. That doesn't make you liable to obtain registration in all those 3 states. You will be liable for registration only in Gurgaon. But you open your office there and start giving consultancy service from there, then you will have to obtain registration in those 3 states also.
Okay. Thank you, sir.
So I'm Vikas Lal, CFO for Group Sub India. My question is about the imports. we say with the CVD being replaced with IGST and the same will be creditable. So is this not against the Make in India concept? So we are having a factory in India and there are many, many people who are just importing from various parts of the world. So are we not going to be disadvantaged by having a factory versus people who are going to trade from other countries?
Why? How you will be at disadvantage?
So because today the CVD is a cost if they are trading, tomorrow with IGST it will be creditable to them.
But you will also start getting credit of central excise. You will start, as a trader, you will start getting credit of central excise, service tax, because whatever taxes you are paying today, for example, you are procuring from other states, you are paying CST, you don't get credit. You are transporting those goods from other states or maybe within the same state, you are paying service tax, you don't get credits. So you will also, the trader in domestic goods will also start getting substantial amount of credits which are not admissible to him today. So therefore, the cost of sales of local, of that trader who is dealing only in domestic goods will also come down. Similar is the case with imported goods. So you are at par. IGST rate will be same whether you import or whether you procure interstate domestically. You will get credits. Today you don't get CST credits. You don't get anti-tax credits. You don't get service tax credits. So therefore, you are just picking one thing that now CVD was not allowed as credit, but now IGST would become creditable. But you are not comparing what kind of credits you will also start getting on account of this GST. Because now everything would be allowed as credits.
But for any future investment, people will prefer to import than set up factories then.
See, the decision to deal in domestic goods or imported goods will not be driven by tax policies now. If you are competitive, you will be in business. If you are not, you will not be. But today, some decisions are taken because of tax policies. I will open my factory in Baddi. I will open my factory in Uttarakhand because there is an exemption. Now, it will not be possible. So, you will take business decisions driven by economic rationale of those decisions, not driven by the tax policies.
One more question. For factory in Baddi, what you mentioned, the refund for the people who are still eligible will be the output liability of CGST, or will it be output liability of CGST minus the input credit of that factory of CGST?
Don't give ideas to us, I will say that. You will get 58%, that is the decision of CGST. So you have given some idea that we should give only of what you are paying in cash. No, that is what you are suggesting. So we'll take your suggestion into account.
Thank you, sir.
Sir, I am Rajesh Goel from Punjloy and looking after the tax affairs of the company.
Please bring the mic close, we are not able to hear.
Sir, I am from Punjloy. Sir, we are having a centralized session at Delhi because our registered office is at Delhi. We are having Senate carry forward for approximately 5 crores. But our output services are at Delhi are very nominal. At Delhi are very nominal.
Okay.
So can we take Senate carry this benefit in other states? We are having operation all over India.
I think the transition rules are very clear that firstly, if you are having a centralized registration in Delhi and suppose you have 15 other locations which are covered in that centralized registration which are located, let us say, in 15 states.
Yes.
So you will be given during migration process only one registration in Delhi.
Okay.
In other 15 places, it will be a subsequent activity because will not be able to give you migration in those 15 states. So as far as registration is concerned, this is very clear.
Yes.
Now you have this, you are filing return of service tax only in Delhi because of centralized registration in Delhi. But that credit is for all those 15 states also. The transition rules clearly provides that 15, the credit for those 15, you will be allowed to opt that how much credit you want to transfer to state A, state B, state C, state D and so on. So that will be left to you, as long as the credits which you avail in 15 states is equal to or less than the amount carried forward in your return filed against centralized registration. And on the top of it, there is the ISD provision also. So therefore, you should not worry. Whatever credit is getting as the closing balance in the last return under service tax regime, that will be allowed to be carried forward in the manner you want. If you want to take it to 15, you can take it to 15, only to 5, you can take it to 5. That provision is very clear.
Okay. It is our option how much credit we want in state A, how much credit we want in state B. That is our option.
Yes, it is optional. It is as per your option. It is as per your option actually.
Okay. Thank you, sir.
Good evening, sir. This is Neeraj Goyal. I'm working as a CFO with Jaguar Group. My question is regarding this anti-profiteering provisions. So what is going to be, the understanding, like if we are increasing the price now, it would be treated like that, considering the GST, if we are getting the benefit, we are just trying to increase the prices now. And if practically we are going to increase the price after the implementation of GST, then it would be treated like that. Just to avoid passing on the profits, we are increasing the price. So what kind of the lead time we are going to consider, or what is the practical situation, the way ahead we are going to consider?
See, I was listening when this question was being discussed in the panel. See, this is an enabling provision. I think most of the officers from the government side have always made it clear that we don't intend to use this clause immediately. But this provision is there just to ensure that this is not done by the industry. We were really worried that now when you start getting credits of most of the things, or in some cases the tax rate may go down. Why we are worried? Please appreciate first that. Today when I buy a car, what is shown on the invoice as taxes is 14%, 14.5% VAT. If the VAT rate is 14.5%. But is tax only 14.5%? The answer is big no. Because it has embedded tax of central excise, CST, entry tax, service tax, and host of other taxes. And therefore, the incidence of tax, which I just talked about, on car is not 14.5%, but it will be, let us say for discussion's sake, is 28%. Now, what would be shown on the invoice? Not 14.5. It will be shown as 28. So, what is natural human tendency? If I now want to go for purchase of car, what will be my reaction? Or what will I be told? कैसा GST आया है 14% था 28 हो गया यही होने वाला है ना so but actually पहले भी 28 था पहले it was not shown on the invoice now it is shown on the invoice so therefore we were really worried that the tax rates, the incidence of tax would continue to remain the same, but yet it would be projected or it would be felt like that the tax rates have gone through the roof. So to take care of those, those kind of scenarios, this provision was built in. And it says that if the tax rates have gone down or if the input tax credits are not allowed, then it should be passed on. And this specific condition is there only in one transitional provision. And then there is a specific section. But nowhere in any other transitional provision this provision has been made. Only in one transitional provision that this benefit should be passed on and then only you will get the credit. That is what has been mentioned in the law. So we are going to check only in respect of that transitional clause only. Generally we don't intend to use it. It is a deterrent clause and it is there in the law. And if somebody complains that, somebody was mentioning that any tax officer can ask for this information. Believe me, we will not have that much time to do this. We are going to have 80 lakhs assessees, right? And then we would be struggling with our activities only. 80 lakhs assessees is not going to be handled. So there would be initial problems also. So there is a clause, I can just assure that it will not be used indiscriminately.
Basically, sir, practically if you just talk about, there are the several factors, be it the raw material, the metal is the main factor. So metal prices are going up.
And if you will see the clause, it is mentioned that there would be some authority who would do this. Now, who will be that authority?
Right.
It can be a new authority. After all, one inspector going to someone, he is not an authority for doing that. There would be some authority which will be appointed, or it can be given to Competition Commission itself. So that is too far. You know, we are not going to pounce on you right on day one, that on 10th July we'll see what was your price before on 30th June and what is the price now. Who will have all that time?
No, that's fine, but proactively we have to just plan now. So that is why I was just asking this question. Thank you.
No, you have to just ensure that, you know, whatever benefits are there, that seemingly are available, you should not be increasing because of this problem which I have just now mentioned, that the tax rate which would be shown on the invoice would be substantially higher than what is shown today on invoice.
Sound good.
Although this is the tax incidence on those goods.
Sound good. Thank you so much, sir.
Sorry? One final. So this restriction is not from our side, huh?
Can I ask a question, sir?
You have asked many questions. Let somebody ask. Please give the mic to him, please.
Since I have a chance to ask the last question, so the last question will be, is going to come from 1st of July. What is the government stand on that? Because a lot of ERP IT package is not ready itself. We are struggling to see the package from the SAP or maybe any other IT firms. So what is the government stand or view on this? The data implementation of the GST.
You have seen the press meet of Revenue Secretary day before yesterday. It is available on YouTube also. Please see the answer in that. The government stand as of today is that the government's intend to introduce from 1st of July 2017. I am making year also very specific. 1st July 2017. And government has no choice. Only 2 months window is there. We can't go beyond 16 September in any case. So, you know, we are trying to introduce with effect from 1st July. That is why we are doing work day and night. Even today, we are having rules committee meeting. 14 rules have already been put in public domain. There are few more rules which have to be put in public domain. Some 7-8 more rules are to be put in public domain. The tax rates are going to be discussed in Srinagar on 18th and 19th. So you will get sufficient indication probably after this 18th-19th meeting. If the tax rates get decided in that meeting, then one can be more than sure that it is coming on 1st of July. But if the tax rate doesn't get finalized in that meeting, then you can be reasonably sure otherwise also.
We have taken, Radha sir has taken many questions from your side. There are questions from our side also. The prominent question which is basically at present the executive commissioners are facing. How many of you have taken migration to the GSTN? That shows that there are many of you have so far still not migrated to GSTN. It is a sincere request from the government side also. This is basically is in your interest. If you are basically migrating to GSTN at this point of time, then it would be convenient for you also, so that those last minute hustles would not be there. And at the same time, if there are some issues, there is a possibility that there are some technical glitches, some technical issues which are there for migrating. If you are basically taking action at this point of time, and if you are raising those technical issues or glitches to the government, probably government would be in a position to resolve that within a time-bound manner. Otherwise, everything would prolong or would extend to the 30th of June. Then it would be very difficult for anybody who would like to operate in GST to make taxable supply as well as to claim the credit. So it is again, a sincere request from my side that you please, if you have any issues with respect to migration, please bring it before the respective executive officers, or if there are no such issues, please migrate before 30th of April. We have already given a deadline on this, and the government is no mood to extend this deadline. Thank you.
Thank you so very much, Shri Gupta and Shri Jain. Let us put our hands together for all the time that they've given. Thank you for your questions and your answers there, sir. I'm sure a lot of us here have more questions. Please feel free to tweet them with our hashtag EDCFO, and I'm sure sir and his team will be more than happy to give you answers. And of course, a little later when we have an opportunity to network, we'll all be here, and it's going to be yet another opportunity for us to interact. But to thank you for your time, sir, we'd like to invite on stage Mr. Kanchlia yet again. Ladies and gentlemen, please put your hands together as he steps forward to thank Shri Gupta ji and Shri Jain for their time and for all the help that they've been giving us this evening. Thank you so very much. I'd also like to take this opportunity to request all our delegates to please fill in the delegate feedback form. This will just give us a chance to make our next summit a lot more informative. We'd like to know what you've been thinking till now. And of course, let me tell you that there are some fun prizes to be won this evening. So I'd like to request all of you to please fill those up so that our team can collect those, and we'll have some prizes being given out a little later this evening. Let us put our hands together for all three of them as they step towards the audience. Thank you, sir. And now, as we get set for our next session, I'd like to welcome on stage Mr. Anil Kuruvilla, Global Leader, Tax and Regulatory Compliance and CCO at Advocate Group, once again joining us for his very, very special address. Let me tell you that he has been responsible for indirect tax change globally at Thomson Reuters. Over the course of several years, he delivered timely information to help global business deal with many tax regimes changes in North America, Europe, and Asia. Let us put our hands together as he steps forward. May I request all of you to please welcome him? Thank you.
Good evening, and thank you for joining us here at the Economic Times CFO Summit for Gearing Up for the GST. I'm pleased to be here with you tonight to discuss the opportunities and challenges which face all of you with GST implementation. But first, I'd like to thank the GST Commissioner and the Additional Commissioner for joining us this evening, our sponsors, and the panelists. Events like this are important to foster cooperation between industry leaders and ensure that we're sharing knowledge and best practices. So, everyone in this room, and based on the questions that you've asked the Additional Commissioner and Commissioner, who have been very gracious, is actively preparing for the GST and looking for answers on how to best accommodate their business needs. Now, it's generally understood that the GST will be a net positive for India by creating a single tax regime that will reduce distortions in price and competition. And that it really has combined the best efforts of corporate leaders, tax professionals, lawyers, and the government to create something that is, I think, unique and is unique to the entire world. But really what is here is that it's also an opportunity to think of a different way of approaching change. And really that, as we are coming closer to the July 1st implementation date, the questions we should think about are we also prepared for an environment where change is going to be part of our business and regulatory culture? I think we are hoping the GST is going to simplify things. I think in some ways there can also be more changes that have to be implemented in a shorter amount of time. For example, are you going to be able to produce new reports quickly enough in a matter of weeks to respond to changes? How are you going to preserve old rules, old data, as new rules come out? This is really part of a change in a mindset where you're thinking about change as a norm. Now, in this case, really just using technology is not enough. What you have to consider is how you support your tax process. And really that is when you have a technology offering that weaves the legal, business, and technical functionalities together. And it gives you a way of interacting with your suppliers, your vendors, your advisors, your customers, so that you can be compliant, but you can also really save time and money. That's what we should be thinking about here, is that it's an opportunity to look at all of these processes we have, and while there are new requirements coming out, how can we work to save time and money also? So, indirect tax change is something that I've done for a while, and I can say that there's a visceral immediacy to indirect tax change. Everywhere in the world, tax rates can change. When we look at it, really, the United States has 15,000 taxing jurisdictions. And they have, in aggregate, about 600 to 700 changes a year. That's not too bad. And then you also have Brazil, where you have hundreds of changes every year for different levels of taxation. But after that, easily, the most complex tax regime is India. And while the GST will simplify the number of regimes you have to deal with, it does still require compliance. It requires compliance and it requires accuracy. Now there is a premium going to be placed on ensuring that the information is correct at the outset of the transaction and that you're ready for that. So if I look through over the last couple of years, there have been a number of different GST regime, or VAT and GST regime changes. We talked briefly on the panel about Malaysia. Now, in the case of Malaysia, it was an implementation of a GST in a country that had no multi-stage indirect tax before. There was a manufacturing level sales tax, and there was a service tax in Malaysia. There wasn't a credit-based mechanism tax in Malaysia until the implementation of the GST. Malaysia gave 18 months in terms of implementation. And even with that, and actually a huge influx of foreign tax professionals, it was difficult for a number of businesses to comply. Much like here, it was in the SME sector where there was a challenge in complying with this regime. Overall, after the implementation, there have still been challenges. And there are very nuanced changes that have occurred in Malaysia. So one thing that all businesses in Malaysia have to do are they have to report taxable codes. They don't have to put them on invoices, but they have to preserve them. When the regime began, there were a total of 24 taxable codes. Now, that doesn't seem like a whole lot, but how do you keep track of 24 codes? How do you maintain those codes? And I'll add that today, there are 26 taxable codes. So 2 new codes had to be added. And also along with that, 3 codes changed their descriptions and how they're defined. That's a total of 5 changes. If you are a large MNC or a large Malaysian company, you have an army of tax people who can go and find those changes, develop a plan, and implement it. But if you're in the SME sector, how are you going to keep track of that information? Are you going to be able to query the Royal Malaysian Customs every day to find out? No, you have to rely on someone to do that. And I think that's what's going to come out here for India, is there needs to be a reliance on our tax professionals. They're going to be key to helping everyone stay up to date on changes. Because one thing that's been very positive here is the proactivity of the GST Council in providing information and really trying to explain how this regime is going to work. It's a new idea, it's a broad-based change, and it will impact every business process you have. Then the other change really is in a very mature regime, which is the European Union. The European Union is a collection of 28 states, member states, soon to be 27 when the United Kingdom leaves. And I think there'll be a lot of UK residents who will be very happy when they leave, because one thing that you get when you leave the European Union is you don't have to comply with the EU VAT system, which is a cornerstone of the EU. But that system has existed in some shape, way, and form since 1978 and has been in a series of continual change since 1978. Looking at the revised directive, the directive began in 78 and was recast in 2006. Between 1978 and 2006, there were 50 separate changes that were implemented across member states that at that time went from 10 to 28. Sorry, 27. And really the last change that happened in the European Union was the taxation change for B2C services. And that is changing how electronic telecommunication and broadcasting services. So when you watch videos online, how that's taxed. And that changed to a location of a customer. That change happened in 2015, but the rules for that change came out in 2008. But what's interesting is, although everyone knew that change was coming, many people didn't begin the preparations for modifying the source systems, changing their compliances until 2014. And if you think, how much did the world change in terms of how we provide electronic services between 2008 and 2014? Whole new rules were written on how business worked and how services were delivered. So, kind of moving forward with the European Union, those changes are still difficult to implement because you have to have someone who will take the Commission directive and see how it applies in local law. That change is hard to do, and it requires a combination of tax, technical, and functional people to come together to do it. Now, the last example I want to talk about is what happened in Puerto Rico. How many here know where Puerto Rico is? Right, so Puerto Rico is somewhere in the Caribbean. It's part of the US. So Puerto Rico is a US territory, and to deal with the crippling financial crisis, they decided to implement a VAT. And they went and passed the legislation, had returns, rules, everything. The regime was supposed to take place, and at the last moment, the Puerto Rico legislature repealed it. So hundreds of businesses had actually made preparations to collect and remit VAT. And they had to essentially, as they were coming closer to the deadline, prepare for undoing all the changes they had just done. So when we think about all of these things, you're seeing situations really where there's always some kind of change. So, when we think about what's going to happen with GST, which without a doubt is the biggest tax reform in the world. I mean, there is no other tax reform that is on the scale and magnitude of what's going to happen with GST. No, nothing has come like this, and honestly, nothing will come again like it. So when we think about those GST solutions, how is that solution going to accommodate changes to the GST? It's not just a question, is it compliant today with the GST, but is it ready to help you make a change? How much time do you have to put in to change one rate, make a new report? Does the solution let you create a framework for a tax process? And your tax process could be as simple as something where one guy just checks a box, but it might be something where you have to have people in each office check data, review data, have external advisors review it, or maybe you've moved it to an offshore facility and you want to have that data. But the idea here is that there's a place where that framework is created, and now that framework is there, it has a process behind it, and it can even be internally and externally audited to give you confidence in it. And finally, how are you able to react to the change as an enterprise? How are those systems and processes ready for change? Then thinking about it, all of the knowledge that everyone is gaining here through this transition is valuable because the next indirect tax regime changes are coming in the Middle East. Many of you here are heads or work in multinational corporations. How can you enable your colleagues overseas to better prepare for tax regime change? Because this is the most challenging tax regime change in the world. And the tools and the processes you're building here can be applied globally. So I would like to thank everyone for their time this evening, and good night.
Thank you so very much. And ladies and gentlemen, we'd now like to move on to our next session. Please put your hands together as we get set for our special address on cash flow visibility for CFOs. Let us welcome on stage Mr. Neeraj Total, Managing Director, Concur Technologies. Let's put our hands together as he steps forward, please.
Thank you. Mr. Baker? Yeah, sometimes it's painful to do the same session twice. I already did part of this before. So for those of you who were there, please forgive me. We're talking about this as a digital transformation opportunity, and as I said in my earlier session, Transformation doesn't work if you think of just automation, if you think in terms of ERP codes only, if you think in terms of taking your existing processes and moving them towards bits and bytes of technology, right? Who is Concur? Concur is the world's largest spend management company, a division of SAP globally. 42,000 customers worldwide. All the big companies in the world use us. And they use us for something they call spend management. Let's look at working capital challenges. And I asked this question in the CFO workshop earlier this evening. How many CFOs actually have real-time visibility into the amount of working capital they have on a daily basis? This is the number for the Australian market, 8%. The number in India, out of a room of 40 people, 2 people put their hands up. And that's like, this is one of the biggest challenges of CFOs today. How do you get visibility into your cash flow situation? I've ran a series of startups. The one thing that worried me was, I know how much money there is in the bank, but I also know I owe my vendors so much. I know this is the amount of money that needs to be collected, but I have a team of 14 people out there selling. There's a lot of, fixed spends, the spends that we know are fixed, and a lot of variable spends. And sometimes you can get hit by a very large variable spend at the last minute that throws all your projections, all your cash flow situations out of whack, and all I had to do at that point in time is go back to the bank and try and negotiate a loan. Working capital loan. Not good for the business, right? But this is life and this is reality for many companies here. What transformation is, and using technology, a lot of companies are now using technology to contain costs, to increase their visibility, most importantly to manage spend. You can't manage spend until you know where the spend is coming from. Right? That's the first step. The second part, let's start looking at digital transformation by looking at the guys who are changing the game. Earlier, you wanted to borrow money, you used to go to a bank. Now there's so many companies that are actually rewriting the rules of cash flow. Small companies that start off providing payment as a service. We'll talk more about this. GST, massive. You guys have heard all evening about what GST is and how transformational or challenging it's going to be. My personal point of view is, treat it like Y2K, right? We don't know whether we're going to be ready for it, but, go after it, change your systems, change your processes, and believe me, July 1st, we'll all survive, right? All of us panicked before Y2K. Some of us are old enough to have been there. We didn't know whether our systems were going to be running. We didn't know whether our planes were going to be flying. But you know what? The steps we took, they ensured that we survived through it. And this is the only way I would advise the industry, the finance industry and the tech industry to treat GST. An effective strategy of spend management, and think of the 3 sources of spends. Where do people spend money? The first cost, of course, is your salaries. That's your biggest cost. Then you have procurement. Now, whether it's system-driven procurement, where you're buying desktops, laptops, infrastructure, you have business travel and expenses. Then you have accounts payable that takes care of the procurements that you buy from vendors. All of these, if you could consolidate them into a single window and get a dashboard that gave you real-time views into how much you're spending or in the process of spending, would that simplify your life as a CFO? So that's the first advantage that Concur brings to you. We put all your spends in one platform, right? Now, when somebody needs to buy a ticket to go from Mumbai to Hyderabad, let's say the average cost of a ticket is like 10,000 rupees. We allow the booking of that ticket to happen through our single tool. The minute the ticket is booked, because we are partners with the GDS, the Global Distribution Center Systems, we are partners with low-cost carriers, the cost of the ticket automatically enters your spend management tool, which is linked to your ERP tool. So you're able to provision, this person has booked a ticket costing 10,000 rupees. So 10,000 rupees, even though we pay the vendor later, needs to be provisioned. He books a hotel, he stays into, whether it's a 5-star or a 4-star. We have partnerships with the leading hotels in the world and in India. So the minute the person spends money on booking a hotel room and he checks out, the spend that he does in the hotel, the receipt, automatically gets captured by the spend management tool, right? Accounts payable, or forget accounts payable for a minute, like even taxis, right? So we have partnerships with Uber, Ola, all these guys. So any of your employees takes an Uber or an Ola for business travel, you don't need to get the receipt, come back to office, print it out, attach it to a manual expense report. So we do expense reporting, but by eliminating the expense report completely, right? It's all system driven. All the spends are captured at source. What happens if he spends money at a place that isn't a partner for Concur? You simply take a picture of that bill. You take a picture of that bill, the OCR scans the amount, scans the location into your expense report. Right, so the perfect trip for us is one where employees no longer have to create expense reports because all of the expense reporting is done automatically. The data is captured at source. Now, the beauty of this is because the data is captured at source, the expense report is pre-populated based on the guy's travel and where he's spending money. 15 to 18% of that spend is going to be GST related. Because it's captured at source, because it's fully compliant with the GST numbers identified, the tax 1, tax 2 components identified, you can automatically reconcile this and offset it against your output tax and put that money back into working capital. So what we are showing you is a way to put back 15 to 18% of the money that your employees are spending back into working capital for the next 2 to 3 months. So it's a way of getting your money back to work for you as opposed to waiting for employees to come back from the business travels, fill up that expensive, expense report, which pretty much how many people do on time? Most people don't even do on time, right? Now you can try and force them, but people will still make exceptions to it. So take that tax component, put it back into working capital, and look at the float on 15% of spends for even a period of 1 month. You get your money 1 month earlier, or you're able to offset it 1 month earlier, that's savings for you. When it comes to accounts payable, the invoice part of it, this is the list of the partners we have in India, Ola, talking to Oyo Rooms, Redbus, Indian Railways. So our vision is wherever employees spend company money, we want them to be an API partner with us so that anytime the person sends you a bill, it gets captured and it goes into the expense management solution. In terms of accounts payable, so this is typically 10% of your OPEX. The remaining 90% is the payments you make to your vendors, right? And no CFO, no finance guy likes to pay their vendors on time. We may want to pay our vendors on time, but paying our vendors on time implies that you're giving money up earlier than you should have, or you should be. And we like to hold on to our money as soon as possible. GST is going to change all of that, right? But think of it as an opportunity. Now, when a vendor submits an invoice, there's a couple of issues, right? Some of the invoices are duplicate invoices. Some of the invoices have critical fields missing. When the invoice comes to you, whether it comes to you via email, via PDF, via hard copy, we capture the invoice at source. So we capture the invoice the minute it hits you, because all scanners today are compatible with Concur's invoicing tool. The data fields are pre-populated, and that data goes through the internal workflow. So the first part is collecting the invoice, the second part is capturing the data in the invoice, which is OCR fundamentally, and the third part is the workflow that says approval 1, approval 2. And for a long time, till last year, we stopped there, right? We just stopped at doing workflow around invoice management and accounts payable. But last year, we had an epiphany that, this is one part of it. What about the payment part? What can we do to make life easier for payments against invoices that our suppliers keep raising for us? All of us intend to pay our suppliers on time because, at the end of the day, we are also suppliers to some other customers, right? Very often we don't do it just because of cash flow. We don't know whether the provisioning we have done is going to last us till the end of the month or till the next big paycheck comes in from an external customer, etc. So what we did is we tied up with payments as a service providers, people like InvaPay, Vyana, who take on the burden of paying your suppliers. So they pay your suppliers on your behalf, giving you the ability to go back to the same suppliers and say, you know what, instead of paying you after 45 days, I'm going to pay you within 2 days. In exchange for this guaranteed payment, will you give me an early payment discount? And we have statistics that say that this early payment discount ranged from about 2% to 3% in most cases. So our suppliers, in exchange for guaranteed money within a stipulated time frame, are actually willing to give us a cash discount of 2 to 3%. You take about 0.5% and you give it to the payment as a service provider, you still net out 2.5% positive. So there's a good way of making your invoice management, spend management work for you. The other part is this. These vendors who provide payment as a service, at some point, you have to pay them as well. But you don't pay them upfront. What they do is they allow you to put all that spend that they're putting on your behalf, they allow you to put it on a P card, right, a procurement card, which works exactly like a credit card except for business procurement purposes. And there, if you're smart about how you pay them, you typically get about 50 to 56 days of float before your card payment becomes due. So your money is working for you in two ways, where you're able to pay your supplier early, and getting an extra discount on early cash payment, plus you're getting 50 to 56 days of free credit period, right? And that's a huge saving in the long run. So that's basically the workflow of how the cash flow situation works out. I think this is an interesting statistic. We are the world's largest spend management company. On a typical day, we have about 300,000 expense reports processed, right? And our customers are the world's largest customers. They're the world's most agile customers. They're also some of the world's oldest customers. 170 million trips and expense reports created and warehoused. We have statistics by industry on how much manufacturing sectors in different markets, what they typically spend on. We use this data to give it back to you and show you ways of how to negotiate better rates with your suppliers. Imagine if I were to tell you that 90% of your spend happened in the period of this month to this month, and it happened with this vendor and that vendor, right? All of this is archived, the data is available, you can run data simulations on it, and you can go back to your suppliers and say, whether it's a hotel or whether it's a preferred airline, and say, we spend so much, we should be getting an additional discount. We have about 120,000 trips that are booked on our online tool, right? So in a sense that the other advantage of putting all your bookings on this tool is you don't really have to spend a travel agent money, and they typically charge about 300 to 350 rupees per ticket booked, when you can do it yourself, right? Because we are plugged into the global distribution system for most airlines and individually into the LCCs, the low-cost carrier booking systems. About $130 million of invoices are processed on a daily basis, right? So these are hard numbers, these are facts, and I think what we fundamentally realize is our customers, when they go for an integrated solution from us, typically recover the cost of the solution in about 3 to 4 months, and more importantly, they actually save about 4 to 5% of the money that they're spending today. So that's pretty much our pitch. Thank you very much for your time. I realize it's late and I'm keeping you guys from dinner. Yeah, thanks.
Thank you so very much. Let's put our hands together for him as we take this opportunity to thank you with a token of our appreciation. Ladies and gentlemen, I'd like to invite on stage Mr. Druman Shah from ET Edge. Please put your hands together as he steps forward. Thank you so very much. And of course, he'll be joining us a little later. So all those of you who'd like to have a one-on-one with him, feel free to do that. Thank you so very much. And as we get set for our next session, which I can assure you is a very interesting one, I'd like to remind all of you to please fill those feedback forms. That's how we can make our next set of summits very, very interesting. And I'd like to tell you that you might be very lucky because we shall be taking out 2 lucky winners out of those filled up feedback forms. So may I request you to please fill them up, and somebody from our team will make sure that they collect the same. And a quick reminder to all those of you who happen to be active on Twitter, please use our hashtag. Feel free to put in comments, questions with our hashtag EDCFO. And now moving towards our next session, I'd request the guests to please remain seated. We are all set to present our next session, post which we have a very interesting panel discussion before all of us meet for dinner. So I'd like to request you to bear with us as we get set for our session on perception versus reality. I'm sure each one of you agree when we say that and doubts pertaining to technology adoption and its impact on positioning and more. Ladies and gentlemen, this is what brings us to the subject of our session, which is perception versus reality. We have 2 experts. Each one of them will be going for perception versus reality, respectively. Let us put our hands together as I welcome on stage Prajit Ghosh, partner in direct taxes, KPMG. Applause is running the house for Pavan Pichara, director, Udyog Software India Limited and CEO at a Care Group. Welcome.
Okay, so friends, we won't take too much time. 10 minutes is all that I have. And my role in this dais is to talk about some of the key issues, some of the perceptions, some of the questions, which I today, when I stand up and speak in front of you, is quite surprising. But as I was about 6 months to a year back, these sounded to be some of those natural questions. So Pawan, the first question is, we are habituated to this 3 letters word now, right? What is GSP? What is ASP? What is API? Right? All of this sounds quite Greek to me, right? Because I'm a finance professional, and it looks like that we are transported to a world where possibly technology is going to drive us away. Yeah? So Pawan, can you explain us the ecosystem comprising all these terms?
So obviously GSTN is going to play the biggest of all roles. They are trying to get data from 8 million, estimated 8 million, it could be much larger as we go through, 8 million companies, and these are large number of transactions that they need to receive. So the call is whether GSTN will interact with every software system or every individual organization, or is every organization ready to consume these APIs? API, is basically an interface for you to either give the data or get the data, or give information and get information. So they've decided to kind of create a supply chain for themselves. They've decided to first start off with GSP. GSP's primary role, as you will understand, is to submit envelopes on behalf of companies. Now, these envelopes are going to be encrypted. By whom? The ASP is supposed to encrypt these envelopes. So the encrypted data is going to be put in first envelope, and the encryption key is going to be given by GSTN directly to ASP. So using that the envelope, next what an ASP does is they put that envelope in another envelope, which is going to be given by GSP to an ASP. So then submit it to GSP. GSP is going to open the first envelope, put the inside envelope. They are not supposed to look into what that envelope has. They'll take the data, the encrypted data, which is again given by the GSTN. They'll put it in another envelope, which a GSP gets from GSTN, and give it to GSTN. GSTN has the key to open that. So that's how, those are the specific roles for GSP, GSTN, and an ASP.
Yeah, the other question which I often get is it must that we have so many taxpayers, would everybody engage GSP for their compliances, or would they engage ASP for their compliances? How do you see this happening in reality?
Do you want to directly engage with GSTN? Yes, you can directly engage with GSTN. GSTN is also going to give you certain utilities, but are these utilities going to help create efficiencies, help analyze if you're actually saving money or losing money? Indirectly, are you properly setting off, or is the input tax credit that is being actually calculated by GSTN the right input tax credit? These kind of questions will determine whether you can directly post to GSTN or not. But otherwise, yes, they are not going to give APIs to you. APIs have to still be taken from a GSP. But if you want to directly operate on their portal, then yes, you can operate on their portal. Yeah. To add a last thing, if you have anything more than a few thousand transactions, then it will be a difficult, tedious process to input all those transactions in an Excel sheet and keep submitting and reconciling.
Great. So, Pawan, this is going to be a big question, okay? So, we've talked about so much stuff, right? And you are one of the very few people who understands technology and the tax landscape very well. What do you think is required to be done for the day one switchover? So, can you elaborate what needs to be done? Because as a finance professional, I know I have to get a hang on my pricing. I have to get my compliance system in order, more in terms of understanding how the taxes would work. Possibly I've looked at the contract part, supply chain part, and all of it. But technology appears to be a CTO, CIO domain sometimes. But what do you think as a finance professional everybody would need to be aware of for a successful migration on day one?
So it's probably the best question that is getting asked across the board. The first thing, is GST impacting your business, or is there a necessity that GST is bringing where you are looking at business transformation in a way, right? Are you realigning your supply chain? Are you realigning your warehouses? Are you realigning your pricing? That's something I think most finance leaders are already into. But then, are you realigning your IT systems? So that's the question that I'll take in a little more detail. The first thing, when we are looking at a switchover from any existing taxation to GST, is about your master data. Is your master data standardized, wherein your suppliers, GSTN numbers, their locations, a lot of ERP systems will only have a supplier. Do you have details of supplier locations? And then are you aligning a purchase transaction from a particular supplier location to your particular location? Standardizing master data from supplier's perspective, from customer's perspective, because B2B transactions are going to be critical for both you and your customers and your suppliers. So standardizing of master data is going to be the first major requirement. Of course, item masters have to be updated with HSN and SAC codes. The second thing is, are your ERPs, most of the ERPs, they are saying they're going to give you these patches, they are going to get you ready. But first thing you have to look at is, are they going to work on your scenarios? How to apply place of supply rules, how to apply place of service rules? Or is that something you have to configure? And that is left to you. They are not going to give you that. They are going to give you provisions. If they are going to give you, they are going to give you provisions to add master data like HSN, SAC codes, GSTN numbers, but that's where they would stop. The requirement is on you to kind of create those rules. Now, what if you are using an older ERP which is not being supported by your ERP providers, right? SAP says they are going to give patches only for 6.1 and more. Oracle says 12 and more. So what are you doing there? Or if you are a banking company, or if you are a logistics company, you are operating a lot of software systems, do you have time to put in all these? So tax determination as a utility, wherein you can ask some system to determine the tax and give you back the result, whether it is in a live stream mode with an API call again, or in offline mode. So that becomes a necessity for your switchover. These two, I think, are something which you will require for business continuity. So on the day of switchover, you should have these systems well tested. For at least 1 month, you should probably have the systems parallelly working, right? A non-live system working if the simulations for taxes are going correctly. The third thing, obviously, the main thing obviously is, are you compliance ready? First aspect is, are you business transformation, are you ready to transform to calculating taxes and all? But the second thing is compliance readiness. There, I think, three main things that I would like to say. First is, are you capable of transforming data, your purchases, your sales, or your inward transactions, which in itself has multiple other transaction categories? Are you transforming the data? A. B, are you running your transformations by time? A lot of people do not understand when a lot of people are coming into tax technology. Some of us who've been there. I'll give you an example. Today you are filing your taxes, a hypothetical example. Today you're, let's say 2018 December, you're filing your taxes, regular returns for 2018 November. But then there is an audit request for which you are attending, which is 2017 December. Now, the GST being a new law, but otherwise also you've seen the changes in service tax, you've seen changes in reporting formats required by VAT in different states. So Do you think the same transformation that is going to be working in 2018 December for regular return works for 2017 December audit response? No. That is where you will need, what is tax technology? I'll come to that a little later, but that is where you will need transformation by time, applying of rules by time, applying of reporting formats by time. So that's first thing. And second, if you're actually working with a lot of source systems, you will need to probably, and if your sales transactions are happening in 2 or 3 software systems, CRM system or your point of sale systems or your order booking systems, or if you're a financial industry in multiple systems, there you will have to get the sales transactions from multiple systems, merge the data by each transaction type, and then submit to the. So do you have merging? Then when you go into a little more detail, are you capable of segregating the data by each GSTN or location? So transformation of data becomes very important. And then data qualification. One of the things that GSTN is putting as a major requirement is data qualification, right? Reconciliation, data validation, fixing the erroneous data. Does the solution that you are adopting allow you to qualify the data, and who is the rightly suited person to qualify your transactions? Is it your taxation department, or is it your purchasing teams and your sales invoicing teams, right? And in that case, is your tax technology extendable to your purchasing and sales invoicing team? These are things that I would advise. Last but least, of course, reporting to GSTN, we being in this industry since last 24 years, the change that you need to accommodate as per GSTN on a monthly basis. This is monthly reporting, so monthly basis you should be able to change your IT systems, right? So this.
Yeah, so Pravan, this sounds like a lot. So last question, and this is my favorite question, and often been asked this question a number of times, is what is that can be done? So as we walk out of the room, maybe tomorrow when we start attending to our office, what is that I want to do right from tomorrow, and how do I spend my time in the next 60 days before it is run up to GST?
First thing I would form, again, situations between a banking industry, some of the banks we are working with, some of the logistic companies, some of the manufacturers we are working with, some of large trading houses we are working with. Situations differ, but I would say first standardize your masters. So form a team which will standardize your masters. If you are having multiple source systems, adopt a system where your master data is standardized in one place and redistributed again to your different software systems. The second thing I would suggest is ensure your scenarios for place of supply or place of service rules are properly adopted. If you are not confident about doing that in time, use an external tax determination engine. Third, obviously, the compliance portion. Start preparing for extraction of data. If you can find a solution, in data transformation world, a lot of people talk about ETL, extract, transform, and load. What we suggest in compliance world, extract, transform, and load doesn't work. What you should be doing is extracting in your native format, loading into the tax engine, and let the tax engine take care of transformation. Because the minute you're putting the impediment on your IT guys to supply in a common format, then any change, the guys have to revise their programs. That works in a compliance like service tax where I have to report 6 months, every 6 months, but that doesn't work. If you're depending every month on your IT guys, it will be difficult for them to cope. Finally, your business softwares called ERP, they are supposed to provide you efficiencies, stability to business, and then offer consistency in day-to-day business operation. Don't subject your business softwares like SAPs of the world with the changes that are not in your control. So try and apply the change, try and adopt a tax technology. Look at your ASPs as your tax technology. which will not only do the necessary things to file taxes, but it is also a system which will give you ability to plan set-offs, manage credits, and then, do some other value-added things like that.
Yeah, so Pawan, thank you so much. And I feel personally that technology is a business continuity issue, because without technology, nobody can even think of doing even a fraction of compliances which the GST is asking us to do. And I'm sure you would have guessed by now that compliance is going to be a primary objective to go ahead with. And I see the whole world changing as we go ahead. And possibly if we have the same conversation, maybe from 1 year from now, we'll realize that how far we've walked off. So thank you so much, Pawan, and thank you so much for your time.
Thank you.
We'd like to thank both of you and give us an opportunity to present each one of you with a token of our appreciation. I'd like to invite on stage Mr. Kanjlia once again from our team to thank you both. I think I'd like to take this opportunity to thank you both. Bear with us a couple of minutes till we set up for our next session. Ladies and gentlemen, we are now at a moment all set for our interactive session on discussion board, sectorial impact of GST. And as we get set to introduce our next set of panelists and moderator on stage, I'd like to remind all of you to please fill up those feedback forms so that our team can collect the same and we can get all set to take out the lucky